Carson Investment Research recognizes that taxes matter since clients can only access after-tax returns. We're using several tools to minimize the impact of tax drag on returns, and in several cases actively trying to enhance tax alpha. To that end, AQR Flex is a premium tool that can generate significant tax alpha, potentially creating sizable tax assets, meaning capital losses. These can offset tax liabilities that are in the form of capital gains. We have a unique partnership with AQR, who we've worked with extensively over the last few years to create custom solutions that can solve problems unique to a client situation. In addition to our investment team and planning team in Marquette, we have a deep bench of high qualified professionals that assist us in these investment strategies. AQR is a highly respected investment management firm that was founded in 1998. Prior to that, the three founders were at Goldman Sachs from 94 to 98. The firm has a significant number of advanced degree holders who continuously produce top quality investment research. They've historically managed assets for institutions, multifamily offices, and retail clients. Their work is innovative and combines economics, behavioral finance, data, and technology. AQR continuously explores what drives markets and how it can be applied to client portfolios, and their research papers have won numerous awards, which can be found on AQR.com. Their approach is based on fundamental investing, which relies on economic theory and analysis to ensure long-term repeatability, systematic application, bringing a disciplined approach to their models, and thoughtfully designed portfolio construction and risk management using quantitative and qualitative tools. AQR's tax-aware strategies go beyond solutions that have traditionally been used by taxable investors. Their research in this space has won awards from well-respected investment journals. AQR particularly excels at practically applying academic quality research to client portfolios. They continuously innovate on their existing stock selection signals, portfolio implementation, and risk management. AQR Flex is a separately managed account with no liquidity constraints or lockups. Funds can be added or withdrawn from the account at any time, though there may be adverse tax consequences to doing so. The objective of Flex is to generate investment returns both from the core portfolio and the long-short extensions, while at the same time realizing significant tax losses and deferring gains to the future. The flexibility comes from various aspects. In addition to liquidity, the client and advisor can choose the level of risk to take within the core portfolio, anywhere from a short-term, low-duration fixed income to 100% U.S. equities, as well as the level of active management, impacting the amount of tax losses can potentially be generated. There are several powerful use cases for Flex as listed on the page, whether it's adding excess pre-tax returns and tax alpha to a taxable account, migrating out of frozen low-cost basis stock ETF mutual fund portfolios, or potentially offsetting a significant portion of capital gains from a liquidity event from a business or real estate sale. Capital losses generated by Flex can potentially offset capital gains from private equity allocations. A better core portfolio with tax benefits. Have your all equity or equity bond or all fixed income portfolio work harder for you, beta, excess returns, and tax benefits. Reinvigorate frozen portfolios. Take an in-kind appreciated portfolio and add alpha and renew loss harvesting. We can migrate model portfolios. We can use active extensions on an existing model portfolio to help achieve a tax-efficient migration from the old model to a new core portfolio over time, plus add alpha and tax benefits over time. Also, concentrated stock diversification. We can manage down a concentrated stock holding in a manner intended to be quick and tax-efficient. Tax-efficient business or real estate sale. Combine pre-liquidity planning and deal structuring to help a business owner keep more of what they have built. With AQR Flex, you can allocate a core portfolio to a mix of stocks and/or bonds as reflected by Carson Houseview's strategic portfolio managed by Carson. investment research, or 100% U.S. equities using the Russell 1000 or Russell 3000, which would be managed completely by AQR. AQR implements the long-short equity market neutral extensions on the core portfolio to potentially generate excess pre-tax returns and persistent tax alpha. The long extension is a basket of 400 to 500 stocks favored by AQR based on their algorithm, stocks with strong factor characteristics. The short extension is a basket of 400 to 500 stocks disfavored by AQR with poor factor characteristics. Strong factor characteristics include attractive valuations, improving prices and fundamentals, momentum, low risk and high quality companies with strong balance sheets and strong sentiment, support of informed investors and management teams. Tax losses are generated from the extensions and not the core portfolio, unlike in traditional tax loss harvesting. Tax loss harvesting is done only on the long-short extensions. A key feature is that the long-short extensions are expected to generate excess returns over the long term. In other words, the extensions are not expected to generate a loss over the long term, but the long-short extensions allow for tax loss harvesting in up or down markets. The breadth of coverage, 400 to 500 stocks on each side, is critical as it allows for a lot of potential tax loss harvesting opportunities. Even in up markets, all the long positions are unlikely to experience gain, and there's likely to be a significant number of stocks that experience losses and can be tax loss harvested. Similarly, in down markets, all the short positions are unlikely to fall and gain value, and there's likely to be a significant number of stocks that experience losses even on the short side. There are a couple of options to select from when deciding how to use Flex. For Flex 145.45, $100 in a core portfolio will be used by AQR as collateral to buy $45 worth of long stocks and $45 of short stock. Hence, the overall portfolio will be long $145 and short $45. The portfolio is expected to behave similar to traditional tax loss harvesting solutions like direct indexing with a tracking error of 1.5%. However, the advantage is that the tax loss harvesting benefits are typically larger and more persistent than traditional approaches. Also, potential tax benefits can be generated on a portfolio of both stocks and bonds, whereas traditional tax loss harvesting is usually applicable only to a portfolio of stocks. For Flex 200-100, $100 in a core portfolio will be used to buy $100 worth of long stocks and $100 of short stock. Hence, the overall portfolio will be long $200 and short $100. Due to the higher leverage and larger long-short extensions, potential tax loss harvesting opportunities are greater, and net capital loss is larger than what you can expect with 145.45. So the 200-100 option is useful if you're looking to mitigate significant capital losses, perhaps from diversifying out of concentrated stock or from the sale of a business or real estate. Flex 145.45 can generate about 32% of the starting net asset value and net capital losses in the first 12 months, assuming the core portfolio is invested in the Russell 3000. Within 2 years, Flex 145.45 can potentially generate just under 50% of the starting net asset value in net capital losses. Note that these are average expectations, and the real-life experience can deviate up or down relative to these estimates. But unlike returns from the core portfolio and returns from the long-short extensions, which are both unpredictable, especially over short time periods since they can vary widely depending on the market, expected net capital losses have lower overall variation. This is especially useful for planning. Flex 200-100 is much more powerful than Flex 145.45 and can generate significantly more net capital losses with just under 100% of starting net asset value generated in net capital losses over the first 3 years, assuming the core portfolio is invested in the Russell 3000. Flex is a liquid, separately managed account that is available for implementation. It is ideal for higher net worth clients as implementation issues result in higher minimums, including $1 million, $1.5 million for the 145/45 and $3 million for the 250/150. The expected return, the alpha from the long-short extensions, is a key feature that is not available in traditional tax loss harvesting like direct indexing. For Flex 145/45, the expected return for just the long-short portfolio is 80 basis points, while the Flex 250/150, it's 330 basis points or 3.3%. Note that this is on top of expected returns for the core portfolio. The long-short annual return expectations are net of AQR fees and margin costs imposed by Fidelity or Schwab. So, for example, say the core portfolio is a 60/40 stock bond portfolio with annual expected returns of 5% over the next 10 years, pre-tax. Implementing Flex 145/45 over that same core portfolio would take the annualized expected return to 5.8% for the overall portfolio pre-tax. AQR has been running factor portfolios since their inception in 1998, and before that at Goldman Sachs from 94 to 98. They've continuously adapted and refined their approach using data and technology. However, the core of their philosophy has remained the same, that fundamentals matter as markets underreact to changes in fundamentals in the short term and over-extrapolate them over the long run. They apply this in a systematic way to ensure discipline and repeatable results. Another core belief is that diversification is key, since even stocks with positive characteristics can underperform for a while. In addition, the diversification across hundreds of positions is very useful for tax loss harvesting. AQR has been running long-short portfolios since their inception, and this systematic application of their approach has allowed them to generate excess returns and create tax alpha as well. AQR's approach to investing in stock selection combines several hundred signals that incorporate backward and forward-looking information. Their algorithms consider data from financial statements as well as other dynamic sources. They use indicators that have traditionally been used by the investing community to identify stocks with good characteristics, but also have several proprietary indicators as well. Risk management is a key consideration for them when building portfolios, and diversification is essential to avoiding concentration risk, whether in a single stock or even in an industry or sector. Their stock selection signals seek to identify stocks with attractive valuations, improving prices and fundamentals or momentum, low risk and high quality companies with strong balance sheets and strong sentiment, support of informed investors and management teams.